Hi, folks. Welcome to our Ask Me Anything. We're going to just give it a few minutes to let some people join, and then we'll get going in a minute or two. Okay. Still a few people trickling in, but the rate of entrance is slowing down. Get into in a few seconds, and we'll get going. Okay, let's do this. Hello, all. Happy summer. Welcome to the Climate Institute's Ask Me Anything on industrial carbon pricing. Really happy you could join us here. My name is Dale Beugin. I'm the Executive Vice President at the Climate Institute. I'm joined by Dave Sawyer, our Principal Economist, and Dean Evangelou, who's going to be our Master of Ceremonies here to help run through some questions. I want to acknowledge right at the bat that I am sitting here, as always, in what is now Ottawa, but is also known as the traditional territory of the Algonquish and Anishinaabe Nation. I was down at the river known as the Kichisippy earlier today. This is a territory that I deeply appreciate, and I'm always grateful to be sitting on and doing both work and play. Thank you. We're going to start things off with a very quick presentation. I know you're all here to ask questions, but we wanted to sort of set the stage in a way with the big picture first to answer some of the questions maybe you're not asking as well. We're also going to, I should note that there is closed captions here in French if you want those. We're also recording the Zoom call. So I think that's all the housekeeping I need. In terms of questions and answers, put them in the box at the bottom once we get to that stage. Okay, let's share that screen and do a quick overview. Okay, thanks so much, Dean. Let's go to the next slide. So as many of you might know, we talk about industrial carbon pricing or large emitter trading systems quite a lot here at the Institute, but it's actually not one policy we're talking about. It is multiple policies, different policies, tailored, different provincial contexts, implemented by different provincial policies, backstopped by a federal policy that applies in a few jurisdictions. There's also an outlier here that matters that's in yellow. Quebec has a cap and trade system that is different than other systems, but still is consistent with that federal minimum standard in enabling some level of coordination and harmonization across the country. But again, multiple systems, different design elements, different design choices, lots of variation. Next slide, please. Okay, a quick explainer here about output-based carbon pricing. This is the system that's in place in some form or another with some variations in every province except for Quebec. The way this works, the policy establishes a performance standard. Think of that as a threshold in emissions intensity, emissions per unit of stuff produced, dollars of stuff produced. Firms and facilities that do better than that threshold can generate credits that can sell for cash to other regulated entities. Firms that do worse have to pay the carbon costs for their emissions that exceed that threshold. That means when the system is working, there's always incentive to reduce emissions because it's always worth generating credit they can sell into that market. More to come on that. But it also means that firms don't pay the full cost. They don't pay the carbon cost on all of their emissions. And that's, in theory, the best of both worlds. It's lower costs to avoid incentives to shift production and investment elsewhere, but it's still maintaining that incentive to reduce emissions. Let's go next slide, please. I mean, animation will just go right through it. There we go. This is a little bit out of date, but it's an analysis from about a year ago from the Climate Institute. And a couple of things I want to pull out. This highlights the emissions reductions expected from a swath of federal policies in place. As you can see, large emitting trading systems, these industrial carbon pricing systems, are the most important policy in terms of emissions reductions in 2030. They're the biggest contributor to emissions reduction. They're also a bit of a range there, and that range reflects interactions with other policies. And that highlights that there's really important design choices needed to get this right. For this policy to live up to its full potential as Canada's most important climate policy, design matters and design details are really important. Next slide. I alluded to this too, but this is some math and some numbers that make it really clear. This policy has been designed to keep incentives for emissions reductions high, but costs to firms low. And this is our analysis and our team's analysis trying to quantify those impacts. And you can see that some sectors, on average, actually see net benefits, depending on the way the systems have been designed and where those thresholds, those performance standards have been set. But all of these sectors have relatively low costs. Even that oil and gas sector, as Dave likes to say, when you think of that in terms of costs per barrel, that's about the value of a Tinbit per barrel of oil. So yes, there are costs, but let's make the materiality and scale of those costs specific and put them in the right context. Dave, let me pass to you.
Okay. Thank you, Dale. Hi, all. So I'll go through some of our findings from our independent assessment of carbon pricing systems. This is the second report we did for Environment and Climate Change Canada in cooperation with the provinces and territories. And we did about a year and change of analysis where we talked to folks, we looked at the systems, we did modeling, we did some math, and we came up with some observations about the systems. And here they are. So generally, we find these large emitter systems are cutting emissions effectively. They're doing an okay job. We notice between our two assessments, our first one we did 3 years ago, and then this latest one, systems are more aligned, thanks in part to the federal government pushing folks along to align their systems, but also in part the provinces themselves looking around and trying to minimize differences across the system. So we see better alignment, which is a good thing. When we looked at the numbers, as Dale just indicated, on cost, more or less these systems are protecting and working as designed. Some facilities are under, financial hardship, and most systems adjust to deal with this. But by and large, the costs are manageable, and we have profit and sales tests that we can talk about if you like, how we sort of assess, well, how material are these costs? But then we have some yets and some buts. So a lack of transparency undermines the price signal and trust in the systems. These systems are very opaque. There's not exchanges. There's not a view of the market price. A lot of bilateral deals being done between folks. So we don't have a market and we don't have compliance information to understand how they're working. And the regulators don't really have a good sense either. So adjustments become hard. And then we like to say modernization is a key to restoring effectiveness. It's a good time now to take a look at these systems and update them. One of the things you'll hear a lot about in the press is this notion of linking. And everybody's been looking at linking for a long time. Simply put, these sort of mitigation islands, these provincial systems are not really that cost effective. You've got small facilities and small markets with high abatement costs, and they can't access lower abatement costs elsewhere. So linking markets and trading units across provinces is a big deal. But pushing that forward without modernizing these systems and making them better, I like to think of junk bonds. So you one junk market, another junk market, you still have a junk market. And I'm not saying the markets are junk, but that's the analogy. So you need to basically strengthen these systems as you think about linking. So there's a whole sequencing that needs to go on. Next slide, please, Dale. And I'll go through these last slides really quickly. So one really fundamental thing to think about is Alberta's system implemented in 2007 really sets the blueprint, the regulatory blueprint for these systems. And in there, they really just cared about cost containment. They didn't know if you squeezed emissions in the heavy emitters, how high costs would go. So they designed the whole system around capping prices. That's the tech fund price, we like to say, or the maximum price where you can buy out in compliance. And they didn't really envision markets and well-functioning markets. And as these systems have grown and as emissions and production has grown, the systems are not really fit for purpose. So they really need a modernization. And we have real-world evidence that indicates this. Right now, Alberta carbon prices are trading at around $26. So there's a bit of a secondary market, and we can observe that on a headline price of $95. So this implies oversupply in the system, too many units relative to demand. the market basically is unbalanced. And then we have 3 years in Alberta of compliance banked units sitting there, which basically means for the next 3 years, Alberta industry wouldn't have to do much to comply. And so again, there's an oversupply. So that points to this need to modernization. And next slide, please, Dean. And basically, here's some analysis and modeling that we did. So we have real world evidence that the systems aren't binding. And then when we look into the future and model this stuff out, it's another data point that says, okay, maybe these systems are not working as intended. They're oversupplied, which means there's too many units around and there's downward pressure on the prices. And it varies by system because each system is designed differently. So that's the top chart. Those are the sort of forecast market prices we see in the future when we put them into the model. And then below with the carbon charge, carbon tax going away, there's a lot of facilities that had opted in, small facilities opted into the large emitter programs that to avoid the full carbon price get a better deal. And now they want to opt out of the system entirely, which then adds more pressure on the markets and basically reducing demand in the markets and further eroding the effectiveness of the markets. So yeah, last bit. So we've come up with some last slide. We've come up with some ideas. You can go to the website and look at the carbon pricing review. We've got a whole document there and walks through these issues, and that's the basis of the work we've been doing. So I'll stop there and we'll jump into questions, and over to you, Dean and Dale.
Great. Thanks, Dave and Dale. That was really, really awesome. Let me just pull up the questions that we have. I know one of the main questions that we got ahead of time was, what is carbon pricing? So I think hopefully Dale and Dave's presentation helped answer that question. So I'll move over to our next one that we got. So for either of you, so under this system, do big polluters have a strong financial incentive to reduce their carbon pollution?
Dave, do you want to start?
Sure. So with the weak carbon prices and the oversupplied system, which is partially a function of a lot of uncertainty around what's going to happen, what was going to happen with the systems, a lot of investment is not moving and hasn't moved. So in the past, we've seen credits being generated and investments being made. In fact, we had put a sort of list together of the investments in the past we have seen that can be directly attributed to carbon pricing on our website. It's 56 billion or $57 billion in investment. So we see evidence it's driving investment. But with the weakened systems, political uncertainty, that leads to low expectations and investors sitting on their hands. And so right now, we would argue there's a fairly weak incentive to drive emissions, thus the need for modernization. Dale?
There's something funny about this too, right? Because there's two levels to the questions. And I think often the intuitive answer to this question is, oh, well, because big industry is only paying for a fraction of their emissions, only paying a price on a fraction. The instinct is to say, well, therefore they have low incentives. And that's actually not true. Like the system's been designed, as I said, to lower costs while maintaining the incentive. That low cost is a feature, not a bug to the way these systems are designed. But the asterisk is Dave's point. If you take that too far, if you are setting thresholds that are so generous that there's lots of supply and not too much demand in these markets, then that nice squaring of circles of having both low costs and strong incentives starts to fall off. So the theory is sound, but the practice of some of these specific systems is problematic right now, and that there aren't incentives because of that credit gluts, but that's not because of the nature of the systems themselves.
You both. I do just want to remind folks that are in attendance that you could use the Q&A box throughout the presentation and throughout the next 45 minutes that we're together to ask any questions that come to mind, or even if you have any sort of technical clarifications that you think of throughout that first little bit, we're happy. This is meant to be an Ask Me Anything, so there are no dumb questions here. This is meant to be anything and everything. But we are going through now a couple of questions that we did get in advance, so we do thank folks that when you registered, you did submit some questions in advance, which are great. All right, moving on to the next one. So Dave, how can carbon pricing drive long-term clean innovation, not just short-term compliance?
Let me start on this one. This is actually one of my favorite questions about carbon pricing, because it's not just the price of carbon today that matters, although that does matter for investment choices. It's also the expectations of future carbon prices, because innovation and those engineers and innovators and venture capitalists funding them, thinking about cool new technologies they might deploy in Canada, they aren't going to come out today. They aren't going to be available in the market today. They're going to be available in the future. So the expectation of high carbon prices in the future is what is that it drives that really strong incentive for innovation. It drives that incentive to find new, better ways to make stuff or do things that society values with a lower carbon intensity. That also raises some policy questions, because we know that expectations around future carbon prices is a little uncertain right now. That's partly because the design choices that Dave's talked about. It's partly about concerns about whether this policy is durable or robust over time. So one of the policy imperatives should be to make this policy durable and robust and strong over time to really drive those innovation benefits as best as it can.
Yeah, does industry believe you that the policy is real and it's going to be around for a while and they can make bets because they're betting lots of money of their cash, often non-productive, but sometimes productive, right? They're trying to profit maximize. They can sell some stuff, over comply. So do you believe? And that's really the fundamental way to think about this. And if they believe, they will invest, right? It just gets folded into business decision making. But as soon as you have, sort of lobbying going on, there's always lobbying and uncertainty in the systems, everybody sits on their hands.
Great. Thank you both. Okay, this next question, a bit more international flair. So, what interest are you seeing from international buyers of carbon credits from Canada? Is this a promising opportunity for future projects?
Dale, you want me to jump on that?
I think I want you to take the first shot. You're the international guy. I have thoughts, but you go.
Well, there's two types of units, right? There's compliance units, which could also be under Article 6 for other countries and for Canada buy and selling sort of compliance units towards Canada's target, nationally determined contribution, but also compliance units for these large emitter programs. And then there's the verified or voluntary market where Microsoft steps in. And so we're seeing a lot of work and action in the voluntary verified market. And really, the mechanisms aren't there on the international side yet to wade into Article 6 under the Paris Agreement. So basically, buying and selling of units. The federal government has to step in and set up a bunch of structures to do that. And the rules around that are just really emerging out of the international process. And so we're just starting to get going. But in a well-functioning market, as we get going, Japan sees selling their tech, their advanced manufacturing, to developing countries and getting an offtake of emission reductions plus trade diversification. Hello, Canada, and our current situation. And so, yeah, it's really starting to emerge. And linking of global markets is a long-term aspiration. And yeah, we need to get thinking about it more.
I think that was great, Dave. Thanks.
Okay, going to bring it back more local. Next question. So, what is the sequencing that needs to happen on a high level to get federal and provincial systems aligned? Good
Yeah, you can
question.
jump in there, right? Yeah.
Yeah, we've been thinking about this a lot, and there's this. Let me start sort of from the outside of this question and come into it in a way. There is lots of conversation right now about linking carbon markets, and there's this growing narrative that getting rid of interprovincial trade barriers, one piece of that is harmonizing and combining and unifying these disparate balkanized carbon markets in different provinces. And there's a certain logic to that, that some of these markets are pretty small, not particularly liquid. There's firms that operate in multiple jurisdictions with multiple sets of rules, and that combining them can all work together. The thing is that before that happens, on the way to any linkage or on the way to unified market, governments have to address the problems in these markets first. And this is back to Dave's junk bonds comment that there's if you link a market that's not functioning well to a market that is functioning well, that dysfunction is going to contaminate both markets. And that's why it's so important that governments fix these systems and that governments tighten these systems over time. There's also a bit of I think you can do this gradually. We think of this in stage that there's early priorities about transparency. Let's make it clear how these markets are working. Let's make it clear what design choices governments are making so that they can be clear where they are harmonized and not with other provinces. Let's make it clear what credits are trading at and what those secondary markets look like so we can get a sense of whether these markets are delivering on the carbon prices they've been designed to or not. There's also a chance to start to harmonize over time subtle things like shared offset markets that start to create sort of some connections. You can start to align some of these design choices of like performance standards, like processes for measurement and verification. And this gradual step-by-step harmonization of systems can lead to both outcomes. It can lead to different systems that are more ready to be linked together, but it can also lead to different systems that are performing better over time. So the staging really is let's get some clarity on the design features. Let's fix those systems to make sure they're delivering on outcomes. And then let's think about unifying them and linking them together.
Yeah, there's some really sort of boring nuts and bolts standardization that has to go on. So, the type of offsets that are accepted in a system, bunch of systems don't allow offsets right now. And there is some linking between Alberta's system and the federal system. Federal offsets sitting in Alberta, for example, small quantities, but there is a bit of linking going on already. And that's sort of how you build it up. You just sort of build it up in time. But standardization becomes a really important piece. And then the federal government leading on national standards using the backstop is helpful, getting provinces at the table to talk about, okay, we've got internal trade problems. We've got differing treatment across the same types of facilities in differing provinces with, misaligned costs. So there's an internal competitiveness issue. Hey, let's get to the table and clean some of this stuff up. And then there's sort of the provinces deciding, okay, we're going to start linking, and maybe Alberta and British Columbia do a little pilot together. They've been talking about it for a long time. The federal government helps there around standards, and then you start to roll that up nationally. So it really is this sort of align systems, pilot into linking, and then thinking about the bigger step later on. But a jump between where we are now to a fully linked system, politically fraught in the short term, technically challenging and a number of years away. Great North Star, but challenging to get there from where we are right now, even with a ton of political capital to burn.
Thank you. I think that was really, really insightful. Um, okay, this next question, which I think might be related to some of the work that we've released recently. So are private investments incentivized by carbon pricing almost always supported by additional government subsidies? Example, the Alberta Tier Fund.
Yes. Oh, you're on mute, Dale.
Damn it. Sure enough, at some point during this call, I was going to do that, but there you go. Bingo, mark checked. So I want to make sure I understand this question, and if there's clarifications, then put them back into the Q&A. That's great. But let's just use TIER as an example. That's Alberta's system. So Alberta's system creates these credit markets, and from the money generated, because firms don't just reduce their emissions to avoid paying the carbon price. Sometimes it's worthwhile for them to pay the carbon price. The government collects that money, uses that money to fund additional policies, additional technologies, and additional ways to reduce emissions. So that means there are two things going on, that the revenue generated is used to help reduce emissions, but the incentive to avoid paying the carbon price also reduces emissions. That both comes from the same policy, but you don't need both of them to have incentives. Even if you're not getting any of that money, you still have incentive to reduce emissions because all else being equal, you would rather not chip in dollars to the government. You would rather, if it's cost effective, find ways to reduce your emissions and improve the performance of your facilities to avoid doing that. It can be complementary, but it need not be complementary.
There's all kinds of reasons why governments throw subsidies out, right? And Canada's very, very good at subsidizing industry. We love it. And so, but from a more sort of ideal perspective or theoretical perspective, like there's maybe reasons why you want to invest in high performing, low emitting steel facilities in Ontario that give you big emission reductions, right? And move away from the sort of the economically optimal solution where, the market decides and maybe government wants to intervene and make some big bets on some technologies. So there's a lot of that goes on in the subsidy programs. At the same time, big bets can get it wrong, and people pick winners, so you have to be really careful. But generally, there's a role for subsidization. When you think about the carbon capture, utilization, and storage pathways, the infrastructure that collects the pipeline infrastructure that collects everything. Maybe there's a role there for government to step in, and then they own a piece of that, and then each facility does their own sort of tie into that network, so it's a network failure. So anyway, there's all kinds of reasons why government does it, but yeah, we fund a lot of tech, billions and billions of dollars we've identified.
Maybe one last thing on this, Dean, because I won't go on too long. But one of the advantages of emissions reductions from carbon pricing is that it doesn't have an additionality problem. So in the case of subsidies, you don't always know whether firms would have done some of the things even in the absence of that subsidy or even at a lower level of subsidy. And so carbon pricing makes sense as your sort of first line of attack for emissions reductions because you don't have to worry about whether or not you're spending those scarce government dollars wisely or wasting them. The market incentives that it creates is going to automatically bake that in, that firms are going to make their own choices about whether it makes sense for them to reduce emissions to avoid paying the price or accept paying the price because their emissions reductions are really high cost. So all the more reason to build on Dave's point about using those subsidies pretty carefully and incisively, to use them in the right places where they aren't doing things, when carbon pricing is not doing everything, can't deliver on all the outcomes you need.
Thank you both. All right. What can we expect from the news that Ottawa's pressed to potentially drop the oil and gas emissions cap for stronger industrial pricing? This very clearly related to some of the work that we've done recently.
Yeah, we published a piece today actually on interactions between industrial carbon pricing systems and the possible emissions cap for the oil and gas sector. So take a look at that piece. Maybe somebody can drop it in the chat actually as a worthwhile read for a link. I think we don't know for sure what is going to happen, and I think that there's still a live conversation. So I don't want to get into the speculation of what is or is not going to happen, but I can start to show some of the trade-offs that our piece does. I think we showed that if industrial carbon pricing is not modernized and is not fixed, then layering on top the oil and gas emissions cap on top of it can drive some significant and material emissions reductions. If you are fixing industrial carbon pricing, modernizing it in our language to make sure those markets are working, and you are doing the emissions cap, then the interactions can get a little bit ugly, and that you're not necessarily getting additional emissions reductions from the cap on top of that fixed LETS because you're actually making it. The metaphor I use is squishing a balloon, that you are forcing more emissions reductions and squeezing the balloon in the oil and gas sector, but it's bubbling up somewhere else. And the way that happens is by making the oil and gas sectors drive more emissions reductions by the cap. They then generate more credits in the carbon markets, industrial carbon pricing. And that glut of credits drops the price of carbon, causing fewer emissions reductions in other sectors like cement and steel and elsewhere in the economy. And so you're not adding these two pieces, you don't get the same sum of the parts. Our takeaway is there's more than one way to think of how those things combine, but the absolute top priority is making the policy we already have, that's already in hand, that's already across the biggest emitters in the economy, work to its full potential. Methane regulations are worth mentioning here too, because they don't quite have the same level of overlap and interaction with industrial carbon pricing. So to a large extent, you can do those methane regulations and you can do the industrial carbon pricing without having them eat each other's lunch in the same way.
Yeah, they're complements as opposed to conflicting interactions, right? One of the challenges with the two policies together, the cap, the proposed emissions cap, and the large industrial emitter programs, is that the regulators don't have markets right now, especially in the large emitter programs, to monitor what that potential glut would look like, and then adjust the system to maintain a price above a minimum floor. There's no price floor in the systems right now. There's only a price ceiling. So maybe $30 is okay right now for whatever reason. Units are trading at $30 a ton instead of the headline price 95, but suddenly those could drop down to zero in some of our modeling. And so the regulator has no way of going in and addressing the oversupply in the market like they do in the Western Climate Initiative in Quebec. So Quebec has a market stability reserve, and there are very clear rules about if the market price or the auctions do certain things, they release units into the system to take pressure off, or they pull units out to tighten the price above the floor. And there's some auction. There's a whole bunch of stuff that goes on. The European Union a trading system, the EU ETS, has the same sort of stability reserves and market information for the regulators to understand what's going on and adjust. We don't have that here. So that makes the risk of the two policies really challenging. Back to the fundamentals of, these markets are opaque and the regulators can't really adjust them short of, in a 3 or 4 year period, adjusting the amount of credits they give folks. But that does nothing for the overhang in the market, the excess units, credits in the system, et cetera. So yeah, the modernization thing has a lot of benefits because it allows regulators to introduce stability into the market when it goes sideways for whatever reason. And it will go sideways, right? And then you've got a band of price that you're playing in, and there's some certainty for industry. They're like, okay, I understand. We're gonna be within this band. I'll put that into my financial analysis for my tech tests, for return on investment. And oh, okay, this works for me, as opposed to I don't know. Yeah.
Great. And I've also posted our recently published work there in the chat for folks. If you're interested, you could access it there. Just published yesterday, actually. All right, next question. What are some of the positive and negative impacts of the commitment to utilize revenues for home retrofits and EVs for Canadians?
Dave, you want to start?
Yeah, I'll start. So, this was a campaign promise from the Prime Minister. It was in his leadership platform and then made its way into the Liberal election platform. Conceptually, it's a good idea, but there's some challenges with it to start. First of all, the quantity of emissions under the federal system, which generate compliance payments, is really low. So there's not a lot of money there to hand out. Secondly, you'd be taking money from Manitoba, which doesn't, for example, doesn't really like you to take the capital out of their province and give it to households all over the place. There's a political issue there. And then when you wade into the politics of using revenue or taking revenue from, say, Alberta somehow, Alberta's using a bunch of the tier revenue to fund their government operations, so they're using it. Every province uses their revenue differently, and it's sort of all politically driven about local priorities. So then you're starting to muck around in revenue in the provinces. So there are the two issues. It's a challenge, right? And then finally, it's a good idea to build a fund of which maybe some carbon pricing revenue comes into it, compliance payments from somewhere else, from industry goes into it, and you fund other programs. But politically, there's a lot of capital I think you would burn in going in that direction.
The other way I've heard this kind of floated as a possibility is not as a link from the revenue, but as to create a sort of offset market. And so you, individual Canadians, could generate offsets for choosing to buy an EV, for putting a heat pump in their houses, and they can get an offset that they can then sell to the big industrial emitters who are covered. This is another way, conceptually, of thinking of kind of expanding the reach of the industrial system. Again, sort of intuitively appealing on one level, but again, some sort of tricky problems in practice. There's risks that those offsets that would be generated would be really hard to ensure that they were fully additional. So, are you buying an EV because you can sell your credit, or are you buying an EV because you like EVs, or maybe that the subsidies and regulatory policies helping to drive EVs have already convinced you to buy that EV? Would you need the full value of that credit? And so there's this risk that these additional emissions reductions coming from these actions from individual Canadians or from small businesses and small emitters aren't necessarily full emissions reductions relative to a business as usual, relative to a case without that policy. And that means they aren't necessarily high quality offsets. They may be bad quality offsets. And now you're trading these bad quality offsets into the system and maybe undermining the integrity of these large emitter trading systems, which have high quality emissions reductions because they're defined by these regulated thresholds, these compliance markets, that it's much easier to ensure there really are additional emissions reductions. So lots of interesting ideas here, and I'm kind of curious to see how this conversation evolves over time, but some big technical complications that really have to get dealt with before this becomes a viable option.
Thank you both. Okay, next question. Just doing a quick time check. I think we're still good for at least a few more. Um, okay, so I think we're like really in an age of a lot of misinformation and disinformation. So I'm wondering if you both can just comment on any sort of political headwinds or misinformation related to carbon pricing. This question's pretty general, but I'll leave it there.
Yeah, I mean, it's tricky, right? As you picked up from our very nerdy conversation today, there's lots of complexity to these policies. So there's some nuance that and things that aren't particularly intuitive sometimes. So I think that it's not always clear in the debate around carbon pricing why that low cost but high incentive things actually make sense. It's not always clear how the industrial carbon price is a different beast than the consumer carbon price and has very different implications for consumers and very different implications for the kind of incidence of those costs, especially because only a small share of the costs are actually being borne by emitters. It's also, I think, really easy to talk about the downsides of any one policy if you're not talking about it relative to other options. If not industrial carbon pricing, then what's the alternative? And that's the real policy conversation. And that's a harder, more nuanced conversation to have on social media or in quick chats that start to kind of get heated and escalatory. But that's the reality of the policy problem that governments are facing. The alternatives to carbon pricing are other policies. You could do more on regulatory policy, you could do more on subsidies, or you could do nothing and you could let emissions continue to rise and Canada not contribute to its efforts, its global efforts to reduce emissions. That's sort of the realities underpinning the real policy debate, but that's not the reality of the political debate about these policies in lots of cases.
Yeah, I mean, the politics in Canada started in election 2007 with the Green shift under Stéphane Dion and Prime Minister Harper. And so up until that election, Prime Minister Harper was driving forward with a very aggressive turning the corner plan with all kinds of controls in place. And during the election, this carbon tax, green shift became job killing carbon tax as a pure stump issue on the election. And it became a beautiful wedge. And then Jack Layton in 2011 proposed a cap and trade system, and it worked really well again for Prime Minister Harper. And it didn't quite work as well with the Trudeau election, obviously, to frame it that way. But so you've got this whole sort of group of folks whose norms, sort of right-leaning folks, their norms, the political class has been for over a decade, almost 20 years, saying job-killing carbon tax. So that makes the receptiveness to the misinformation sort of just meet their priors. Oh yeah, it's bad. And so that's what you're fighting against. The political scientists have done a lot of work on this, and it's really fascinating. Like it's really hard to change people's opinion once their norms have been shaped in a certain way. And that's really what we're dealing with when we talk about the polarization in the system.
That's great. Thanks both. So yeah, just a reminder, folks, like continue to ask questions in the chat. We're getting a lot of great questions. Just a reminder, if we don't have time to get your question, we maybe have about 3 to 4 more questions before we need to wrap up. If we do not, I will post my email in the chat. Please feel free to email me and we'll try to get back a written answer to you. So please feel free to do that. We want to hopefully get to everyone's question. All right, to the next one. Sort of going back to the interactions between various policies in play currently in Canada. You've talked about interactions between the industrial carbon pricing and oil and gas cap. What about the clean electricity regulations? Do you think fixing industrial carbon pricing systems could eliminate the need for clean electricity regulations?
Bill, you want
Go
me to
ahead,
jump
Dave.
in?
Yeah, go for it.
Yeah. So I look back in time to the coal phase out in Alberta and the revision under Premier Notley to the, then the SGER, then the CCIR program, now TIER. And basically the carbon pricing design in combination with a regulatory ban out in the future accelerated the phase out of coal-fired generation in Alberta, and it blew everybody away how fast it happened. So when you think about carbon pricing and a regulatory ban, which the ban has some flexibility into it, has compliance flexibility to keep costs down. That's what the CER has. You think of these two instruments as staging and being complementary in time. And so if the carbon pricing is being tuned in time, consistent with what the CER is saying, you can see rapid movement and deployment. And then when we talk about expectations, industry says, oh, right, the CER is there. I believe in the current carbon pricing system. Okay, I'm going to make my investments accordingly. So the two are complements, and we'll see what happens. But to me, it makes perfect sense the way they're designed right now.
One extra nerdy piece of conversation to add to this conversation that in lots of provinces, the industrial carbon pricing system, as it applies to electricity, is particularly tricky, and different provinces are doing it in a different way. Alberta has had some success by allowing renewable electricity generators to generate credits, and that's helped drive renewable electricity in Alberta. That's not always the case in other systems where these zero emitter small generators can generate credits and therefore have incentives as well. There's also a balance in how these systems are designing themselves, or the provinces are designing them to make sure that they aren't spiking the price of electricity, and that's for political reasons in lots of cases, but it's also to make sure that this policy doesn't get in the way of electrification as sort of a key pathway on the way to net zero. And there's also some problems in how the federal version of this policy that still applies in a few provinces thinks about different kinds of generation and different ways of generating electricity having different rules under the industrial pricing system. And that is, there's some reasons for they would do that for pragmatic reasons. We can get into that, but it actually sort of creates weird incentives as well. So that's a long way of saying that in some ways, the industrial pricing systems are not doing electricity perfectly. And that's all the more reason why the electricity regulation is a really useful backstop for that really important sector, as we have to build up so much new electricity to meet growing demand, both for new uses of electricity as well as to drive the shift towards electrification. So getting that sector right is hugely important.
It raises, just going to jump in here too, Hander. It raises some interesting choices that are made by the provinces. So the federal government has this backstop regulation. And that basically says, look, if you don't meet certain tests, we're going to impose the federal OBPS system. So there's a net demand test in there, which basically says we're gonna look at what you are proposing, province A, what you're proposing in terms of allocating your credits and setting your benchmarks. We're gonna see if that we're gonna run it through a model and see if the market creates net demand, and that means you'll have a positive price that'll approach the minimum, the national carbon price, $95 a ton today. So each province makes those adjustments, and they have full latitude to apply the cost or the benefit of those credits any way they want. Some jurisdictions have chosen to give some sectors a big break and hit electricity really hard because it's non-traded and they're worried about their industry folks. Now, what happens when you hit industry harder is it flows, the electricity sector harder, it flows through to consumers. And so that's a choice. There's some choices going on. And as Dale said, in Alberta, Alberta chose to incent renewable generation in their system, and that's actually put downward pressure on prices because of the subsidies being created. And so it's given breaks to consumers. So, design really matters in these systems when you think about incidents, who gets hit and how much. And typically it's provincial choices.
Okay. I think time for one more question and sort of one wrap-up question. Um, so this person was wondering, what are your views on the feasibility or likelihood of Canada developing a carbon border adjustment mechanism similar to that of the EU? And maybe just, I'll add this on, maybe for folks that aren't aware what a carbon border adjustment mechanism is, if you could just briefly talk about that as well.
Dave, you're written on this. Why don't you start?
Yeah, okay. So why do you want a border carbon adjustment mechanism? Let's start at the beginning. So you have misaligned costs with the average cost you're applying. That chart Dale showed you, the tin to barrel chart, where it's $10, $7, $4 a ton for various industries. Those costs are not being met by competitors in some of your markets, domestic markets and away markets, export markets. And that misalignment leads to leakage, which basically means you penalize Canadian companies with the price and production shifts offshore and emissions rise there, and we're worse off globally, perhaps. So a border carbon adjustment is really designed to deal with some of that misalignment. So right now, about 40% of our imports and exports go to or come from jurisdictions with carbon pricing, including California. So it's not 100%, but it's not zero either. So there's some misalignment, but it's not off the charts in most cases. So the border carbon adjustment mechanism basically applies an import tax tariff to realign basically the carbon prices. So what does that mean? In Canadian steel companies right now, not the big foundries, but more the manufactured folks, they will likely be paying a charge into the EU on the relative carbon prices they pay in Canada versus what's going on in Europe. And there's some technical work that goes on. So it's very, very highly technical, relative emission intensity of trading products, disclosure of information, back and forth. There's a bunch of stuff that has to go on. So in theory, it's great and people really like it. Complexity matters and we need it ultimately, but pushing along that spectrum or that continuum of sort of framing it up is going to take some time. So I'll stop there, Dale.
Name the elephant in the room too, which is the Americans. And so much trade, so much of Canada's trade of emissions intensive trade exposed stuff, the stuff that makes lots of emissions when you make it, but is traded in international markets like steel, like cement, like aluminum, it goes to the US. And so the imbalance, this competitiveness pressure that comes from unbalanced policy, we're talking about the US in lots of cases, but that also makes it tricky to talk about border adjustments that we're now imposing on the US. And that creates some geopolitical problems in the world we are in right now. It creates some challenges in terms of raising the cost of things we're importing from the US as well. So in a perfect world, Canada would be doing a border carbon adjustment arm in arm with the US, and that would be the way to kind of square that circle to some extent. I think it's still an important conversation. It's still worth doing research on. It's worth thinking about it. We certainly need to be ready for the fact that border adjustments are happening with other trading partners like the UK and in the EU, but that there are some bear traps to avoid as we think about developing the same kind of policy domestically. I have to be pretty careful in doing that from a sort of a realistic, practical perspective.
And some of the stuff we need to do around modernizing the large emitter programs, which is understanding the relative costs imposed by each jurisdiction, Canadian jurisdiction, on their emitters. Some of that information we have to look at and think about aligning is needed to basically build a case to the EU to explain what we're paying so our exporters don't get double taxed. So they pay here and they pay there, and they're paying together too much relative to the EU and being penalized. And so the government of Canada, has to think about, okay, what information do we need to collect? How do we convey it to the Europeans? How do we influence the European system? Can we influence it so we're not double taxed and we can reduce trade frictions? So there's a whole bunch of administrative stuff that is sort of common to whether we're responding to a border carbon adjustment or implementing a new border carbon adjustment in Canada. And so, yeah, getting going in that space is basically a priority, I think, for the new government.
Great. Okay, I think we have time for one final question, which I think will really help sum up this whole discussion. So, Dale and Dave, if you had a magic wand that grants three wishes, or I guess it should be technically a magic lamp, uh, what are the three changes that you would make to industrial carbon pricing in Canada?
Dave, you get to go first.
I always like to say expecto decarbonus, which is basically we get a bunch of technology rolled out and built. It's the Harry Potter sort of climate policy thing, expecto decarbonus. We get a bunch of technology built out and working. And to do that, you need political sort of alignment, you need investment, and you need some policy certainty. So those, it's a tall order, but working towards those things, I think, is needed. Dale.
Yeah, for me, it depends a little bit on how magic the magic genie really is. Can I go straight to outcomes, or I have to think about ways to get to that outcomes? Like the thing we really want here is a robust trading system, binding credit markets, and that means tighter systems over time, clear expectations that the systems are going to persist over time and be strong over time. And that sort of requires some political consensus. I really want some real magic. It requires some alignment and cooperation between orders of government. If provinces and federal governments are working together on these systems to make sure that they're working to their best, then that helps deliver that durability. That helps to achieve that sort of long-term functioning of these markets. And I guess the other thing that we're going to need over time is uh, is ongoing tightening of these systems that they're going to get even more stringent over time, to send even stronger systems over time. And that requires, of course, durability. It requires some collaboration. It requires the political swing of the pendulum to stop swinging. We need to converge on a system that makes sense because it does make sense in lots of ways for competitiveness, for emissions, for economic performance. But to really move it forward, we need some stability.
Great. I think we've been able to hit pretty much every question. We do have to wrap it up, so I will pass it to you, Dale, for some final remarks.
Thanks so much for the great questions, everyone. Thanks for joining us. This is a bit of an experiment. Merci tout le monde pour votre question. Dean, thanks for moderating. I want to thank Rosalind and Fraser, our colleague as well, for ably stick handling a bunch of the questions in the chat. Ross was a key part of our carbon pricing review and is a major part of the carbon pricing intelligence here at the Institute as well. But thank you for this. It was fun. It was interesting. I hope it wasn't too nerdy, and we'll see you next time for a future AMA on something else, maybe.
Thanks, folks.